On today's Hot Sheet, I'm discussing housing inventory, the cost of building new single-family homes, and the top housing markets for first-time home buyers. Today is Monday, April the 15th, 2024. I am Byron Lazine, and the Hot Sheet starts now. All right, my apologies. Had a little background distraction there, and I am ready to get into it as we do every single Monday. The inventory update for the last week. I've got great news on that front, and I think we all agree we need a little bit of it here over the past week. We've seen the 10-year shoot up, and I have no good feelings about the 10-year coming down, especially after you look at the geopolitical landscape of what we're going through here over the weekend. I don't believe we're going to see anything close to, a market that it has certainty or, coming into this spring market. I know many of you were hoping for a lower 30-year fixed. I felt like on January 1st, I was maybe one of the few that said not going to happen. I'm not gloating that's certainly the case because I was hopeful for a lower 30-year fixed, but I think we can all agree that everybody talking about 5% 30-year fixed interest rates is getting really quiet, and there's absolutely no signs of that coming anytime soon. With everything that we're looking at, hot inflation reports and otherwise. Here in 2024. The only thing that could shift that could get cuts coming very quickly would be a real rise in job loss and unemployment. And if you're rooting for that, I don't know what to tell you. You are a miserable human being if you're rooting for people to lose their jobs. All right, let's get into what's going on with inventory. This is the good news here. For the week, we're finally seeing it. We're seeing this inventory number now that we're like 2 weeks after the holiday here, because you got to take into consideration we were getting gains weekly on active inventory. Then we had the Easter holiday, which anytime you see these major holidays in the US happen, you will see a week, maybe even a week and a half, 2 weeks after, where some of the data is stunted as people delay decisions or, just kind of push them off for a little bit. Okay, now we're 2 full weeks out of that. And what did we see from April 5th to April 12th? We saw inventory go up 512, almost 513,000 to over 526,000. That's like 13, 14,000 plus on active inventory in 1 week. That is what we're looking for. Same week last year, inventory fell from 412,000 to 406,000. So we are from 406,000 last year to 526,000 now on active inventory. We are continuing to widen the gap on year over year active inventory gains to the positive. We're seeing inventory grow across the country year over year, and the gap is getting bigger, not smaller, as we get into this spring market, as we really get into the core, the heart of the spring selling season. Okay, now we expect at the end of spring and into the summer, inventory is going to keep going up, and I expect more inventory this year than we've seen at any point, since early 2020. I expect inventory to go up considerably this year. We're seeing it in other parts. We're going to get into that, but I expect it throughout the country. Even if you're in one of those markets where you're like, oh, inventory, I don't have any. We're not going to have any forever. Yeah, that's going to change very quickly here. We're seeing the national trend is one that it is trending up. I get it. It is from, near all-time low levels. So I want to put that context on that. But we are seeing weekly gains, and this is what we had hoped and expected to see. If we go back to 2019, same week, which I would consider a more normal market than at any other point in the last 5 years, you saw 850,000 or just under on active inventory. So still well off that mark, and we shouldn't expect to see that this year, but we should expect to see considerable gains as we move through this year. New listing data. New listings were the driver to some degree for this gain that we experienced for last week. We saw 66,786 on new single family listings, completely crushes the same week the year prior at 48,500. It's in line essentially with 2022, and that's basically where we've been all year. We've kind of been in line with 2022. It'd be fantastic to see us break out and exceed 2022 levels of new listing data, because beating up on 2023 isn't saying much. That was the all-time historic low on new listings for any given year was 2023. So, we're beating the last place year for year over year marks. We want to look more past last year to see where we're truly at. Love to see us break out of 2022 numbers, but we've stayed in alignment there for the most part this year, and we are gaining more new listings this year. If that changes, that would obviously be concerning. Here's another indicator that more inventory is coming. When I say more inventory, I'm certainly speaking nationally because it's a national number. 32.1% of homes have experienced a price cut for the last week before selling. So that's common, about a third. Last year, it was only 29.8, speaking to the low inventory numbers. 2022, of course, low inventory, lower 30-year fixed mortgage rates, 18.8%. So we're nearing the historic norm of a true third of homes will see a price cut before they sell. I expect that number to go over a third later on in the year as we get out of the spring selling season. As demand, if demand continues to go down, if the 30-year fix stays up, I think that number could go over a third, right? We've seen, almost a 25% difference in year over year mortgage applications. So mortgage demand is, on pause. Buyer demand is on pause due to the affordability issues. Doesn't mean it's not there in the future. Those people still want to buy, but they need to afford to buy. They need to qualify to buy as well. So that demand is sitting in the background. And if that demand continues to be forced on the sidelines in the background because of 7+% 30-year fixed interest rate, and we get onto the back half or outside of the spring market, and we're still experiencing that, I could see this price cut number go up over 33% as the sellers who are sitting on the market will feel like they are getting little to no little to no interest on their inventory, and they will have to make a decision on whether or not to cut that price. And the serious ones will do just that to move the market. All right. Inventory rising across the vast majority of the country. Let's take a look now, breaking it down specifically where. This chart is pretty fascinating to take a look at, and shows you where the inventory is the greatest. Okay, so 57%, 1 year change, active housing inventory for sale, 57%. The leader in the camp is Florida. So Florida has seen such an incredible jump in inventory here, 57%. Those on the west coast of Florida are experiencing that more than others. Look at these Sunbelt states now. Look at this south region, southeast region. Texas is at 31%. Louisiana is at 29%. Georgia's at 25%. The Carolinas 32% to the south and 30% to the north, respectively. Okay, everybody in the Sunbelt states is essentially 24% and over on year-over-year active inventory gains. What do we know about moves in that region? Is that they typically will be a precursor to the rest of the country. It's what we've seen historically. Okay, when we look out west is kind of a combination of different stories. You've got the Northwest experiencing, 20+% gains, You have California at 11, and then you have Nevada at negative 26% year over year change. Now, Nevada moved very quickly when interest rates went up for inventory to go up. So take that. That's a little bit of context, right? Take that into consideration, that inventory moved up there quicker or more than almost anywhere else. Obviously, a lot of places you saw the interest rate go up and inventory didn't go up at all. Nevada wasn't one of those situations. Inventory went up, and then now you've seen people come back into that market. You do see a lot of folks from California moving into Nevada. So that migration trend hasn't slowed down, and you see Nevada down 26%. Arizona's up 21%. That's another one of those markets, particularly Phoenix. It's a precursor for what could happen in the rest of the country. And then we have the Northeast. Northeast is interesting. I've often said Connecticut and New York, the tri-state, Connecticut, New York, Jersey right now is experiencing the lowest inventory in the country. That's highlighted here. Don't rest on your laurels, Northeast. These shifts are going to come. I think some of the listing agents in these markets are already hearing and fielding more calls, anecdotal instances where they're hearing more people are getting ready to sell their home. I think in a year from now, these numbers are going to be not only in the positives, but in the positives to the double-digit degree. That could be a welcome sign, obviously, for listing agents in those markets. Certainly, will be a welcome sign for buyers in those markets. So you're seeing here almost everywhere in the country, outside of 5 states, is experiencing an increase in inventory here. And as we continue to move forward in this market, I only expect, and continue to move forward in this year, I only expect that number to grow. Okay. I only expect that number to get bigger as we move forward throughout the year. Active listings begin to rise quickly as homes sit on the market longer. In theory, it can signal a weakening market if this were to be the case. If active listings begin to fall quickly as homes sell faster, in theory, it can signal a strengthening housing market. Okay. We're observing some softening right now across many housing markets as higher mortgage rates temper the market that was unsustainably hot during the pandemic housing boom. Most of the country still remains below pre-pandemic inventory months of supply. Midwest, Northeast are in particular reflective of that. National active listings for March 2024 were 37% below, almost 38% below March 2019 levels. And so we still have some room to go, as mentioned there. So active housing inventory for sale compared to pre-pandemic levels, when you look at state overall, even Florida now at the 57% gain is still 14% below as a state. There are pockets of Florida that are higher, but as a state, Florida is still 14% below March of 2019. Texas is almost flat, only down 4% in comparison from today to March 2019. That's interesting, right? You go to the Northeast and these numbers are wild. Okay, you're still looking at 50, 60, 80% in the Northeast below March 2019 levels. California is still 46 below percent. So when you look at it, you look at Florida, you look at Texas as the two that really stick out as getting closer. Texas on the doorstep there of March 2019 inventory levels. That's really, those are the two places right now where I really see buyers having the opportunity to negotiate a little bit. I'm not talking about a cliff in prices or anything like that, but those are very attractive inbound migration states. The migration pattern continues to highlight that people want to live in those two states. And now that you're getting back to pre-pandemic levels, there's going to be more negotiating in there. Agents really need to educate those sellers on that. Highlighting that west coast of Florida, that's where you really see a significant change in inventory for sale, is the western Gulf Coast, southwestern coast, in particular in Florida is really shifting. So still coming down to a micro market there. All right. So those are the states that are seeing the most inventory. You're probably experiencing, or I'd love to hear what you're experiencing in the comments in your market. Okay. The cost breakdown of constructing a single family home. NAHB, National Association of Home Builders, provided Resi Club with the national averages for itemized costs in each stage of construction for new single family home. We often talk about, hey, if the cost of construction for builders was greater, what was less, or they were incentivized to build more affordable homes, that could help with this inventory issue. And you look here, this is what the one that sticks out to me. You've got fees really making up a significant portion of building a home. 2.1 and 1.3 would be 3.4. 4.9 there when you had the 1.5. You got 4.9 plus 1.2 would be 6.1. Other site work gets you up to almost 7.5% on fees there just to sell a home. The biggest driver, of course, framing, including the roof, 15.1%, excavation, foundation, concrete, retaining walls at 10+%. Then you have electrical, plumbing, HVAC, exterior wall finish, cabinets, countertops, drywall. But they don't have fees. They have the fees all broken up individually. If you put the fees in one category, that it costs for builders to be more than the electrical, and it'd be the third share of total costs if you just put the fees and hoops that they have to jump through. That doesn't account for the time that they're holding the land to develop. Okay, so while you're going through the building permit fee, the impact fee, the sewer and water fees, and all these different things, as you're going through that time period, you're holding the land and paying oftentimes interest on the land. Okay, so while you're doing that, that cost is being driven up on your carrying costs. That's not associated in here. So significant cost just to get started for a builder doesn't mean that, okay, well, a builder is going to build more or less homes. They're going to build as many homes as they can protect their margin. Okay. And if you look at the margin right here among builder survey, the average cost sale price of their single family homes in 2022 was almost $645,000. The average sale price. The average sale price so much $645,000. Total construction cost single family home included in the survey was $392,000. That's what builders want to protect more than anything, is that profit margin that they're experiencing. It's why, if they can make money on building fewer homes to that degree, why would they build affordable homes? If the market is going to, basically support that, then they'll build less homes at a higher profit margin. Okay. So that's what the numbers reflect. That's what the builders are going to do. I don't anticipate, as we look forward in the next couple of years, as we're seeing inventory go up on existing home sales, we just highlighted that. I don't anticipate more new builds. I actually anticipate less. Builders have been very conservative in the amount of inventory they're putting out. We're like, oh, we have such low inventory. Why aren't builders putting out more? Well, because they're not building inventory that supports demand. They're building this high price stuff. They're getting a huge margin off of it. They can be very conservative. They can play it safe, 99 down the middle. They don't have to worry about really building a whole bunch of inventory and taking a bunch of risk. They can just make a ton of money off of what they're building right now. Why would they do anything differently? So with that said, I think you're going to see less building in the next couple of years because you have active inventory. That's their biggest competitor. It's active inventory. It's existing home sales. As that goes up, you'll see them build less. And they're in a good position to do that because their margins are so high. Outside of there being some kind, unfortunately, I want free market, but outside there being some kind of trade-off with, hey, you can use this land, build on this land, and build X amount of affordable homes, there's no reason builders are going to build affordable homes. These are the numbers it costs to construct. $392,000 total cost for the average single family home. That's already above what most people would call affordable. So right there, just to build these homes, it's not affordable. And why would they make less money when they can make these types of margins? Builders just aren't going to do that. So the only opportunities for affordable homes are in the existing home market for those that want single family homes. And where do buyers want single family homes? Or according to Zillow, anyways, where are the top 10 markets for first time home buyers? This article's available for you on nowbam.com. St. Louis is 67% of the total for sale inventory considered affordable. So there are still markets where you can get affordable housing. That would be St. Louis at the top, Detroit, Minneapolis, Indianapolis, and now Austin at 5 at 23%. Out of the top 5, that'd be the one place I think that you're seeing a lot of inbound migration into. 23% of for sale inventory is considered affordable, making Austin, I would say, extremely desirable moving forward. Pittsburgh, San Antonio, Birmingham, Kansas City, and Baltimore make up the top 10 for market for first-time homebuyers looking for affordability, according to Zillow. Okay. First-time homebuyers accounted for half of the home purchases last year, highest proportions that Zillow began tracking in 2018. The increase first-time homebuyers from a low of 37% in 2021 underscores the resilience and determination to find a place they still want to call home. Okay, and we know that the largest contingent of buyers here in 2024 happens to be millennials, and so I think that'll be a common trend here moving forward throughout this year. What hopefully is not going to be a common trend for the entire year is a 10-year that is continuing to accelerate up. You saw a big bounce here today in the 8 o'clock hour on the 10-year. Not sure. I know oil prices dropped. I don't know if that's a reason why the 10-year is moving here, but oil dropped just based off what's going on in the Middle East. 10 years now up over 4.626. We really want to stay below 4.25. We want to stay after that below 4.5. So we've kind of blown through both of those numbers. Here's the 3-month look. If you're looking at the 10-year, here's the 1 month. The 1 month, we've seen this big jump, and here's the 1 day and the 5-day. We're continuing to see a 10-year go up. Hot inflation and uncertainty across the globe is impacting that. And we ended the week last week with a 7.3 on the 30-year fixed. I expect it to go up today, by the way. I don't expect it to go down. The Freddie Mac 30-year fixed weekly went up to 6.88. So I expect all of those things to kind of stay true, meaning those numbers are going to be moving up. Which means we need to be more prepared than ever. One of the things I've said at the beginning of the year is survive till 25. Don't count on 5% interest rates in 2025. You're going to be misleading consumers the minute you start talking about 5% rates, especially now that they're going to be nearing 7.5%. When we were talking about 5%, we were talking about a lot of these projections, stating that you'd get to 5.9 by Q4 of 2024. A lot of people took that in the beginning of the year and ran with it as 5% interest rates in 2024. Well, if I'm a consumer, I'm hearing 5, I'm thinking 5.0, not 5.9, and not in Q4. That's what the projections were. All right. We're much higher than that, obviously, as we sit here today. There was going to be a bumpy road for inflation. It seemed obvious. That certainly has taken course. And then there's just a lot of uncertainty. It's like, okay, well, what happened? We just keep going deeper into more geopolitical nonsense. We're not getting further away from it. We're getting deeper into it. Surprise, surprise, an election year. That's going to cause some people to pause up in this market anyways. You still have regional banking concerns with where the commercial sector is. Listen, commercial people that own commercial buildings, multifamily buildings, are going to get squeezed even more in this environment. Their refinances have been coming up, and they're continuing to come up. But what are they going to do? They were hoping for that 6% interest rate to have some wiggle room. Now we're looking higher. than that. It's going to be really hard to get financing on those buildings. That could have a ripple effect in the regional bank world. So there's too much uncertainty to say, hey, we're in a position where these rates are going to come down. I don't expect the Fed now to do a rate cut, which was which was Wall Street's belief here coming into the last couple months. That's why you're seeing the market react. I'm interested here to see what's the market doing today. After Friday's worst day, there's a recovery on the Dow, S&P, and NASDAQ. So that's a good sign. The markets are recovering today, but we saw last week how fragile they are. Retail sales, by the way, jumped 0.7% in March. This is another hot inflation number. Okay, so that's probably one of the indicators on the 10-year. Not as much the oil prices. Rising inflation in March didn't deter consumers. Retail sales 0.7% for the month, considerably faster than Dow Jones forecast for 0.3%. So another hot inflation report. Continued to see that. So what do I expect to see going forward this year? I expect more of the same. Bumpy road, higher cost for financing. It's why agents and professionals in a changing landscape in their world need to be more prepared than ever to continue to add value to customers and to clients. And there's some obvious opportunities to be able to prepare yourself. Number one, on Wednesday, it's BAMFest week this week. BAMFest is going to be this Wednesday at not at 3 o'clock. I think it's at noon Eastern time. Is the free virtual event that is BAMFest. I'm going to be kicking it off with Jared James with a fireside chat about what to do to prepare for the changing landscape. We have Chelsea Pites on Instagram sharing with us, and with Jordan Cohen sharing some listing presentation strategies, Lisa Chinati and others. It's an action-packed event. So we've got that coming up. In June, on the 6th, we have BAM Camp DC. Okay, so BAM Camp DC, Naples sold out last year, and we have early bird pricing, which is selling very quickly. You're going to want to jump in there before the prices go up on BAM Camp DC. We do have a mastermind the day before on June the 5th. If you can't make that, later in June, on June 25th through the 27th, 1000 Watt has their annual summit, now branded the Brand and Marketing Summit. Answering the wake-up call, the real estate event for those who want to meet the moment with confidence. This is June 25th through June 27th. I will be in attendance. This is one of the can't-miss events of the year when it comes to how to build your brand and your marketing strategy. Now more important than ever, what part of your business do you own? Do you control your brand story? I think right now, with the way things are changing, every agent needs to understand exactly how to do that. That'll be in Dallas, June 25th to June 27th. So those are some opportunities there to sharpen the tools and get ready for everything that is happening this year. Appreciate you guys tuning into the hot sheet. We'll be back tomorrow, 9:30 on the East, 6:30 on the West. Till then, toodaloo.